What's up, everyone? It's Eric with Option Edge, and today I want to talk about the diagonal strategy and how I use theta and implied volatility to my advantage, okay, and earnings. So let's get into it. It's going to be another PowerPoint presentation here, all right? So next. So as I've talked before, I did a video, my most recent video was all about theta and theta decay. So just some of the basics. As an option approaches expiration, its extrinsic value approaches zero. Anything that's out of the money options will be worthless at expiry. Okay, something to think about. And here's just a good visualization. As out of the money options approach zero, you can see that we have a fast, steep, exponential implosion of intrinsic value. Okay. So next slide. So the reason I bring up theta up is because when we trade naked long calls, there is a lot of theta decay. Okay. So it's not sustainable. It's not a sustainable strategy. When you see these guys on Wall Street bets, buying calls, I mean, can they get lucky and make a crap ton of money every once in a while? Yes. And there is a time and a place for when you should buy a naked call, okay? But in the long run, if this is the only strategy that you're going to use, you will lose, okay? Because there's too many things stacked against you. There's the lower probability of profit, the higher theta decay, and you're usually always overpaying for premium because implied volatility tends to be overstated in comparison to actual historical volatility. Okay, next slide. So in order to diminish these effects, when we have a naked call, if we want to diminish the theta decay and increase our probability of profit, we have to hedge with another option. Okay, and this is how you be successful at trading options. So here's the setup. We're going to get bullish 2 weeks before earnings while taking advantage of high elevated implied volatility and lower theta decay that's associated during earnings. So we talked about that. And then here's just a nice little visualization of showing you the first half of an options life cycle. We're seeing mitigated theta decay a little bit. And then, so this area under the curve here. And then look at the second half. This is the area of theta decay, okay? Pretty big. So that just shows you that after that inflection point, we hit that exponential decay real quick. But so the thing is, before earnings, there is a special the theta time decay is much lesser during earnings. So if let's say this is the passage of time, the x-axis here. Let's say the date right here is September 14th. The date in the middle is September 7th. We have earnings at, let's say, September 11th is earnings. Okay, so that earnings, earnings doesn't happen. It happens before the options expire. So if you bought September 14th options, earnings would be inside of that expiry on the 11th. Okay, so when that happens, when the earnings is inside of options expiry and the earnings happen before the expiry of the long call, what's going to happen is you're going to see less theta decay, okay? And then it falls off a cliff after earnings. And then this line here is just showing you the normal theta decay, okay? Next slide. So this is how we take advantage of this elevated IV situation and lower theta decay. What we're going to do is we're going to combine two options, okay? We're going to start with a long 14-day option, okay? Buying a long call. And at the same time, we are going to buy a shorter dated 7-day option, a short call. So what's going to happen is that short call is going to decay very fast after it decays very fast, while our long call sees mitigated theta decay because of earnings. Okay, so we're taking advantage of this high IV, low theta decay type environment. Okay, The market gives us this. This is something that the options market will always give us. Okay. Next. So this is called what I call the pre-earnings diagonal spread. I use this a lot. Okay. So what you're going to do is you're going to buy an at the money 2-week or longer option. Earnings date happen within the expiry. So if the let's say if it's September 1st, you buy the September 14th calls, okay? And earnings would be, let's say, September 11th. So that earnings date is contained within the options expiry. Second part is selling a short 1 week out of the money long option, okay? Earnings date happen afterwards. So let's say it's September 1st, we buy the September 7th, or excuse me, we sell the September 7th calls, okay? Earnings is September 11th. You offset the strikes to create a bullish strategy. So basically, this is a calendar spread because we have two different expiries. We have a September 7th expiry and we have a September 14th expiry. Okay. When you leave the strikes the same, let's say we're selling the 100 and then buying the 100 at the different dates, that would be a calendar spread. Okay. When we offset the strikes and we make the option we're selling further out of the money versus the option we're buying, that becomes a diagonal spread. Okay. So next part of this is you close this strategy when the first short strike expires. So if we're selling the September 7th option, we would close the option, both contracts, basically on the 7th day, when if it's out of the money, this will basically expire almost worthless, and you will close out the long side of the trade. Okay. And then another quick little tip is you want to make sure the debit you pay, this should say, is smaller. The debit you pay should be smaller than the width of your strikes, not larger, smaller. Okay. So this is a good visualization. Okay. So what we're going to do is let's start with the longer dated option. Okay. So here's this option here. It's September 1st. Okay. We're going to buy the September 14th long $100 calls. Okay. So that's the longer dated option, is going to be at the money. Then we are going to buy the shorter dated options, or excuse me, we're going to sell the shorter dated options at a further out strike. Okay. And we're talking about calls here. So if this was puts, you would buy a put that was the strike you're selling would be lower in value rather than higher in value. Okay. But here what we're doing is we're offsetting these strikes. We have the 120 call and the $100 call here, and they offset. What's going to happen is this further out of the money call will expire faster, literally, because it's shorter dated, but it will get into that exponential decay, while our long call is seeing mitigated theta decay. Okay. And here's another way to look. So basically the deltas I like to use are the 50 and 30 delta. So you're going to get long at the money 50 delta, and then short out of the money 30 delta call. Okay. So you can see the green call shows us the length of the trade, whereas the red shows you the length of the short trade. Okay. And you're going to close both on that 7th day when the short trade expires. Earnings date should be within this rather than outside. Okay. So here's a great visualization of, we are getting short this portion. So we're going to get that exponential decay. Okay. At the meantime, we're going to see mitigated theta decay on our long option. And what's great is we're going to close this at the halfway point. So we're just mitigating our theta decay by a lot. Okay. And taking advantage of that exponential theta decay here. This is what's the beauty of these diagonals. I love them. They were my most successful trade in 2020. And all right, so that's that. So let's check this out on Robinhood. I took a profitable trade in CVS this week, and let's open this. So earnings, let's look up the earnings date. Okay. So earnings are available November 3rd. Okay. So when this was 14 days out, I did this bullish diagonal trade. So November 3rd is options, the earnings. So we would choose, if we're going to do our long call first. So we're going to choose the option that expires outside of earnings, but is closest to the earnings date. So if that means that the earnings is November 3rd, we're going to select the November 5th options. Okay. So we're going to take this is a 47 delta. Let's say we do the 87.5. I mean, it sort of doesn't matter. Whatever's closest to the 50 delta, technically this would be the closest option to the 50 delta. We'll select that one. Then, so that's our long call. Okay. So I know it's not 14 days, but pretend it is. So then we're going to then sell a call. Okay. A shorter dated call. The options expiry happens the 29th. It is the closest date that happens before earnings is the November 3rd. Okay. Okay. So we're going to sell the 30 delta. Okay. That's the 15 delta. All right. 26 delta. That's close enough. Okay. So what you're going to see is, we have created this sort of calendar spread, but it's really a diagonal spread where the strikes are offsetted. And I don't know if you remember in the slide, I said make sure the debit is smaller than the width of your strikes. So the width of our strikes is $1.5. Okay. So what you're going to see is, let me show you this more pronounced. So this is just for, let's say we sold the 88 strike. What you're going to see is now our strike is only $1 wide. The total debit is larger than that width, right? You can think of this is only $500 wide, excuse me. So this debit is larger than that. So what happens is this can lose money if you, once you get over that larger strike, the 88 strike, it's going to be less profitable. That's why. So if we do let's do a 3 strike wide or 3.5. So this strike here, you can see the debit is $1.87, and the width of this is 1.5 plus 2 is 3.5, 350 wide. Okay, so this is smaller than 350, and you can see that even if this goes above that higher strike at 92, you're going to still make money. Okay. But if you don't make it, if you make it too short, the width of your strikes, you just got to know that if the stock climbs to that larger strike, you close out the trade there, because after that, you could start to lose money. So this is the basic setup, and I do this on my Twitter. I say, hey, I'm going to be doing a pre-earnings diagonal. So this is what I mean. And it really takes advantage of that high implied volatility and low theta decay environment. It's something the market gives you. Take advantage of it, and don't just buy naked calls. Okay. All right. This isn't advice. It's just educational for educational purposes. And if you're liking this stuff, please give me a follow and a like, and I'll keep these videos up. All right. Peace.